Hi everyone, it's Matt Barnes here and welcome to part 3 of our FX trading course. I hope you're enjoying the series. If you haven't already done so, please click the subscribe button below and subscribe to our channel to keep up to date with all of the rest of our videos as they're released. So welcome along. As I said, this is the third video in our series, and in this video we're going to be looking at taking an FX trade. So in part 2 we explored the mechanics of taking an FX trade. And in this video, we're going to be putting all of those mechanics into practice and actually jumping into a demonstration account and taking the equivalent of a live FX trade so that you can see how it all comes together. Just keep in mind that part 2 and part 3 should be watched together. So if you haven't watched part 2 yet, please pause this video, go and watch part 2, and then come back to this. You'll find it a lot easier. All of the concepts will make sense. I'm not going to be explaining everything from part 2 again. It's all there in the part 2 video. So a quick review of what we did cover. We looked at what currencies can I trade. We spoke about going long and going short so we could make money as the market goes up and as the market comes down. We spoke about the concept of a bid-ask spread. We looked at position sizing. We looked at margin, or how much money you've got to put up for the trade. We spoke about tick size and tick value for a trade using the $10,000 base position size, and I encouraged you to put together a little spreadsheet for your own currencies there. I hope you've gone ahead and done that so that you've got a bit of an idea already of the tick size and the tick value of your different currency pairs that you'll be trading. We spoke about financing and on holding positions overnight, and we also looked at calculating risk and reward. So what we're going to do now is we're going to jump into a trading platform. I'm going to use the City Index trading platform, and we're going to take a trade as if we were taking a live trade using all of these things. So let's jump in there now. So this is the City Index trading platform. I'm using a demonstration account here, so you can see I've got $20,000 of equity there just waiting for me to experiment with and to play with. The beauty of a demo account, as you can see at the top left here, it says demo account. The beauty of a demo account is you can get in there and learn the ropes, take some trades without putting your real money at risk. If you remember back to part 1 of this series, you'll remember my very first FX trade was a little bit of an experiment, but I did it with real money in my trading account. This is a much better way to do it. So let's talk first of all about which currencies can we trade. As I said in part 1 of the series, there's well over 100 currency pairs that you can trade. Here in City Index, you can see you can trade all FX markets, or you can break down some watch lists and just look at Aussie dollar crosses. So it might be Australian dollar against the pound, Australian dollar against the Swiss franc, Australian dollar against the euro, etc. Or you can come down here and just click on FX majors, and we'll just look at the major currency pairs. So I'm going to click on this button, and you can see that we've got a whole list of majors popping up. I won't go through all of them. I'll just draw your attention to two things. If you think back to the spreadsheet that we looked at in part 2 of this video series, we were looking at $10,000 lot sizes. And the easiest way to do that is by trading FX CFDs here in the account. That's the equivalent of trading one $10,000 lot size. So if you wanted to trade 50,000, you just trade 5 of these. So if you see a currency pair per 0.0001 CFD, that's the one that you need to look at. If you see something like this, this is the US dollar Swiss franc, but it has December 18 next to it. That's a CFD, or contract for difference, over the futures contract. So we spoke about futures contracts in part 1. If you trade this one, it will be like trading the futures price, which is slightly different to the FX price. There won't be any interest components if you trade there, but it will expire in December. So it will tell you the expiry date. One of the benefits of trading FX is that it doesn't expire and that the market is open 24 hours a day. You can see that over here I've actually created a little watch list. You can click on any of these and add them to a watch list by clicking on this little star button over here. And I've created a little FX watch list on the right hand side here. So I've got the Aussie dollar US dollar, the euro US dollar, the British pound US dollar, the US dollar Canadian dollar, US dollar Swiss franc, and US dollar Japanese yen. So the first thing that we need to do is decide which of these currency pairs we're going to trade. So just for the sake of it, I'm going to trade the first one on the list, the Aussie dollar against the US dollar. So if you have a little spreadsheet created from last week, you'll be able to go and see that for a $10,000 position, you're going to be risking $1 US per point, or per 0.0001. Okay. Next, we need to decide, are we going to go long or short? Now, we haven't gotten to this stage in our FX trading video series yet. In part 5 of the series, we're going to be going into detail in the different kinds of currency analysis that we can apply. So things like fundamental analysis and technical analysis. But we haven't done that yet. So I thought for a little bit of fun, let's go to a random coin flipper website. We're going to virtually flip one Australian dollar coin. If we get a heads, we're going to go long. If it comes up as tails, we're going to go short. Now, I've got to stress, I do not recommend that you trade this way. I'm only doing this to make it clear that this exercise in part 3 is all about the mechanics. We haven't done any analysis. I just need a long or a short option. So I'm going to flip the coin. Heads, we go long. Tails, we go short. And it's a head, so we're going long. So we can flip again, but we're going to stick with the umpire's decision, and we're going to accept our head, and we're going to go long. So if I come back here into the City Index demo platform, we're going to go long the Aussie dollar, US dollar. Now, if you've never taken a short trade before, it's very easy. Whichever one you do, you just click buy first to go long. You click sell first if you want to go short. And that's really all there is to it if you want to create a long trade or a short trade. Remember, in currencies, we're always long one currency and short another currency. So if we are long Aussie dollar, US dollar, we're buying Aussie dollars and selling US dollars, but we just say that we're long the Aussie dollar, US dollar pair. So I'm going to click over here. I'm going to click buy, and you can see that that's opened up a little trading window there. Now, if I wanted to take a long trade, but I accidentally clicked sell, that's okay. It would just open up here as a sell, and I can quickly flick between these and say buy or sell just by left clicking my mouse on there. We've decided that we're going to go long the Aussie dollar against the US dollar. We're just going to place a trade so that we can see it instantly. However, if you wanted to place an order to buy at a particular level, you can use the middle tab here, which is order. And the Australian dollar, you can see, is trading at 72.05 per US, or 0.7205 US, 72.05 US cents. Let's say you didn't want to buy this until the market got to 71.50. You could just type in a price here of 0.7150 and fill in everything else, which we're going to do on the other tab. But you'd fill in your stop loss order, your profit target, etc. Whether you wanted it good till cancelled, good till end of day, or good till a specific time. Maybe you just want it for an hour or two. But whatever you decide, you can click add order, and that order will sit in the system until that level is touched. But we're not interested in that at the moment. We're just looking at the mechanics. We want to actually see an FX trade taken. So I'm going to use the trade window here. And I no longer have the option to change the price because it's telling me what the prices are up here. I can buy at 72.058. I can sell at 72.051. Now, that's actually the bid-ask spread that we've been talking about. So if we were to buy, we have to buy at the higher price. And then when we want to sell, we have to sell at the lower price. And you can see in between those two prices, there's a little number here that says 1.0, 0.8, 0.9, etc. That is the size of the spread. So it's one full tick. So if you're trading a $10,000 position size, the spread is 1 point. There's no brokerage on this trade, but that's effectively your brokerage or your commission or your cost of trading is the spread. So again, if you buy at 72.05 and you decide to get out immediately, you've got to sell at the first available price. So you're going to be losing a little bit of money there. As for the position size, a quantity of one is the equivalent of a $10,000 position size if you look at the spreadsheet that we discussed in part 2. Essentially, the way the platform is set up is you actually don't need to do any major calculations there because it's telling you you're going to be trading 1 point or $1, 1 unit of currency 2 for every 0.0001 that this currency pair moves. So if you buy this at 72.05 and then you sell it at 72.06, you're going to make 1. If you put 1,000 in here, then for every movement between, they're only letting you do up to 500. If you put in 500 here, then for every movement, say you buy at 72.05, it goes up to 72.06, you make $500. So as you can see, you can really make money very quickly in the FX markets, but you can also lose it very quickly. I spoke in part 2 about the 5th decimal place. You can see that we're going to trade 1 unit here. We're not going to trade 500. We're going to trade 1 unit of risk per 0.0001. So that means the 5th decimal place, it still counts, but it means that instead of being $1 per 0.0001, if the market moves 5, you'll make 50 cents. Okay, so it's just that little extra that you'll make or lose. It's very easy to ignore it and leave it alone, as I do. Essentially, I just assume 4 decimal places, and it's just like an extra little bit of change on top there. So I'm going to do any calculations based on 4 decimal places. Now, the next thing that we need to look at is margin. So once I've put in that I'm trading a quantity of 1, I can come down the bottom here and there's a margin calculator. If I click on that, it's going to tell me my margin requirement for the trade is $50. Now, in the spreadsheet that we looked at in part 2, I spoke about I treated margin as though it was a 1% margin. These days, a lot of FX brokers offer even better than 1% margin. Here is $50 to control a $10,000 FX position. That's 0.5% margin, not even 1%, it's 0.5% margin. So with that in mind, if we come back to what I was talking about here, if I trade a 500 CFD position, my margin on the trade, I don't think it's going to let me do that because it's going to be more than what I have in my account. But if I say a $100 position or a 100 CFD position, the margin goes up to basically $5,000. Okay, so or a quantity size of 100 actually means that I'm trading 100 parcels of $10,000, which means I'm trading a $1 million position. And since we're doing this with pretend money and it's just a demonstration, let's trade a $1 million position size. Now, if we're trading a $1 million position size, we've decided we're going to buy, we better put a stop loss on. I know it's only pretend money, but it's good to, they say in sports, you practice how you play, which probably means I shouldn't be doing a $1 million position size on that size account, but let's assume we're having a tight stop loss there, 7205. We'll be getting in somewhere around there. Let's put a 5-tick risk on there. We'll put a stop loss at 7200. Now, ordinarily, that's too tight a stop loss to have. I just want to demonstrate that we're risking 5 ticks or a quantity of 100 times 5 ticks, which means we're risking $500 on the trade, and it's in US dollars, so it will be $500 US on the trade. We're going to put a profit order in. Now, we should be looking for at least a 3-to-1 reward to risk. So let's say we buy at 7205, maybe 7206, so 3 lots of 6. If we're risking 5 points, let's say we'll go for 18 or 19. Let's just make it an even 20. So let's put our limit order at 7225. Okay, and we'll do that good till cancelled. So the trade is actually all set up. It's ready to go. We know that we're risking $100 per tick. I'm going to show you this in action in a moment when we execute the trade. We know we're risking $100 per tick. We know it's going to take $5,000 of margin to be in this trade. We also know we're not going to get a margin call because we're only risking $500 US. So if the trade goes against us, we're going to be taken out of the trade and all the margin will be returned, and there's still plenty of margin in the account. So we know we're not at risk of a margin call. So I want to talk about financing as well, but while we do that, let's just go ahead and execute the trade at 72,053. I'm going to place the trade. So there you go. You have placed an order to buy 100 at 72,053. Your trade is confirmed. Your stops are confirmed. You've got a limit order at 72.25 and a stop loss order at 72.00. See, when it's just 00, they drop the decimal places there, or they drop that 3rd and 4th decimal place. Probably should have made it 72.01 to make it clearer. So it says to monitor your trade, please go to open positions. So let's go there now. So there you go. Down the bottom, we have a $1 million open position, and you can see there's an unrealized profit or loss of $80 US. So remember that we're trading a position size of 100 per 0.0001, and there is a spread of about 0.7 trading at the moment. So at the moment, we're already behind by the size of the spread. Okay, so hopefully that market will move in our favor and we can close this trade for a profit. But at the end of the day, it's just an exercise in seeing the mechanics. You can see at the top, we've got total margin of $5,000. There's still $20,000 cash in the account because we've only opened a trade, we haven't actually closed the trade. And it tells us we have net equity of 19,902. Why is that? It's because we've got a current loss of $100 US, and sometimes these take a few seconds to catch up, but $70 US there is about 97 Australian dollars here. So the profit and loss is in Australian dollars because the account is in Australian dollars. Now it says we have trading resources, 14,902. What does that mean? It means that we've got 19,902 equity in our account, but 5,000 of that is being held as margin. So that leaves only 14,902. So if we were to lose $14,902.59 on this trade, which we won't because we've got a stop loss on, but if we were to lose that amount of money, we would get a margin call where our broker would call us and say, hey guys, please put in some more money. Your account's in a margin call. But as I said, that's not going to happen because we've got a stop loss. Now, as you can see, the trade is going against us at the moment. And I hope if this is the first time you've experienced an FX trade, I hope you appreciate the speed at which all of these things are moving. It's very fast. And that's why you need to be on top of your game before you jump in. You need to know exactly where you're going to get in, where you're going to put your stop loss, and where you're going to put your profit target. You need to get into your platform and go bang, 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 fill it in, place your order, and then walk away and leave it alone. A lot of people get sucked into day trading when they don't intend to. Now, if you're a day trader and you want to day trade, that's fine. But a lot of people get sucked into day trading unintentionally because they see it moving, and often they'll take a trade and they'll make a quick few $100s over trading, and they'll say, this is easy, I'm going to become a day trader. And they get in there and they don't really want to do that. Their personality doesn't suit that. Their time availability doesn't suit that, and it doesn't work out too well. Okay, so think very carefully before you go down this road. The other thing that people will do is they will watch this move around and they'll see their trade run down, $200 or $300, and they'll say, uh-oh, I don't want to lose that, and they'll back out before they lose the full $500, only to see the trade turn around and go ahead and make a profit for them. So the best advice I can give you is that if you are trading on an end-of-day basis, and as a safety in the market student, I know most of us will be trading on an end-of-day basis. If you're trading on an end-of-day basis, put your order on, put your trade on, and then close your account. Turn the platform off, shut the computer down if you're not using it, and go away and do something else. Don't sit there all day. You're going to talk yourself into taking trades or getting out of trades. So while we're in this trade, oh, look, we've moved into profit. Should we take it? We've got $20 profit, or 30, 40, 50, 70, 100, 110. Look at it, it's flying. I'm giving you an example of how the emotions can affect you here. I'm not really sitting there thinking that with this demo money. If we click on this drop-down button, we can go to key market information. And then we need to click on more. By the way, the maximum trade size that you can take is 5,000 per point on this platform. And our size long, 501. What that means is on the platform, if you take a position of more than 500 CFDs or more than $500 per point, it needs to be approved by a dealer. It doesn't just go through the platform automatically. The margin is 0.5%. And as they tell you, once you've got 1,400 contracts, the margin increases. Trading 24 hours. Remember, one of the benefits of FX trading is that it's a 24-hour market. All right, but we need to click on more because we need to actually have a look at the financing charges. So right at the bottom of the screen here, you can see long charge minus 0.39 and short charge minus 0.07. And that's going to be charged in Aussie dollars. So if you're long, it's going to cost you 39 cents per night per one CFD that you trade. We're trading 100 CFDs, so you'd have to multiply that by 100. And the days to roll are 1, so it's rolling 1 day at a time. Now, you might be thinking, hang on, I thought I would either be paying or receiving interest, whether I'm long or short. Here, I'm paying interest regardless of whether I'm long or short, and that's because the interest rate differentials between the Australian dollar and the US dollar are very, very close. So there's not enough of a gap there for you to be paid after the brokers take their little bit out of it. So unfortunately, we're going to be paying interest on this trade overnight. But as I discussed in part 2, interest is really not that big a deal on positions. It's not going to hurt you or help you all that much compared to the actual currency movement itself. A lot of people got burnt in the carry trades in 2008, 2009, holding currencies with high interest rates for the interest, but then losing 3,000 and 4,000 points when the currencies collapsed. So at the end of the day, as we'll discuss in part 5, it's the actual movement of the currency that's going to make us or lose us our money more so than the interest rates. But we know there's going to be a little interest charge if we hold this overnight. So I'll close this off, and all we can do now is sit and wait for this trade to unfold. So I could sit here and watch and wait and see if this trade gets to its profit target. By the way, we can go into our active orders here, and it tells us we've got one order, which is a limit order for 100 at 72.25. That's our profit order. So that's going to be a sell order at 72.25 to take us out for a profit. And then we also have a sell order as a stop loss to get us out at 72 cents if we're wrong and the market kicks us out. These orders are there to protect us. I can leave this running. I'm not going to do it. I'm actually going to close this trade. We're going to click the close button, and the price has already moved up to 72.09. We're up 370 US dollars. Let's close the trade. There you go. You have closed 100 of 100 buy trade at 72.09. This trade resulted in $510.63 Aussie dollar profit. Okay, so not bad for a couple of minutes work. Of course, we were over trading. We did no analysis. We flipped a coin. This is not a standard trade. This is not a typical example. All I did was execute a few things to show you how the platform works. So we've resulted in a profit of $510.63 after any commissions. So you can actually see up the top here, our cash has now moved up to $20,510.63. And we've got no margin anymore because we've closed all of the trades off. Our profit and loss has reset to zero because we have no open trades. It's all been converted to cash. And obviously our trading resources are the same as our net equity because there's no margin to take out of there. So that's as easy as it is to take an FX trade. There's not much to it. You just have to find a currency pair on the side over here. As I said, you've got all sorts of pairs to choose from. I've created a little watch list with the majors in this demo platform. You pick a trade, you work out which way it's going to go based on your analysis. At Safety in the Market, we do a lot of work on trend trading, following the trend, and also price forecasting. How far do we think this market is likely to go in terms of setting our profit targets and our stop losses? So you do that analysis, then you would work out the risk size, which we're going to talk about more in the next video, and then you would move on to the trade from there. It's not a case of just buying and selling by flipping a coin. I can't stress that enough. The coin flipping was just for a little bit of fun. In the next video, we're going to talk about position sizing and basing that on risk and being a little bit more scientific about how we place these. So I hope you've enjoyed part 3 of our FX trading series. We're almost halfway there. You may need to watch this video more than once, and that's fine. The benefit of having the recording on YouTube there is that you can just pause the recording if you want to recreate any of these things for yourself. But I hope I've given you a nice little walkthrough of the City Index trading platform there so that you can see how it all works. Remember that part 2 and part 3 of this video go together as a team. So all of the detail and all of the content is there in part 2, and part 3 is really the analysis or the application rather of these. If you enjoyed the video, please click on the like button below, which is the little thumbs up icon, to give the video a like. And as I said earlier, please subscribe to our channel if you haven't already done so. So coming up next in the FX trading video series, we've got part 4, account management and position sizing in the FX market. So as we've just seen in part 3, we took a $1 million position on a $20,000 account. We'll be discussing questions such as, is that a wise idea when we look at part 4? And we'll be looking at structuring your trades so that you're not over trading or taking too many positions. In part 5, which is a two-parter, we're going to be looking at currency analysis. So we're going to be looking at fundamental analysis and technical analysis. And at Safety in the Market, we do predominantly teach technical analysis, and that's how I do most of my trading, but we will look at both of them for the series. Then in part 6, we're going to look at lessons from history, and we're going to look at some of the things that have happened in the FX markets over time and the lessons that we can draw from those. And then finally, in part 7 of the FX trading series, we're going to wrap it all up by setting up for an FX trade. So we're going to put into practice everything that we've learned in the first 6 parts and set up for an FX trade so that you can see how it all comes together. So again, thank you for watching the video. I hope you've enjoyed it. Please subscribe if you haven't, and I look forward to seeing you in the next video.